everyone, I hope you are doing fine and learning a lot in trading on daily basis. Okay, so after a delay, we are back with the requested second part of gap trading. This video is going to be an intense learning session on methods and strategies on gap trading. And if you are new to gaps, I request you to watch the first part of the video. We have talked about gaps, line charts, candlestick charts, anatomy of the candlestick, and what is gap up and what is gap down. So very quickly, I will recap the first video and then we will see gap trading techniques that can help you make money. We have talked about gaps. What are gaps? Gaps are discontinuities in the securities chart. This happens if the price of a particular security either rises or falls from a previous day close with no trading in between. Check the previous video if you want to know the reasons why this situation happens. Okay, then we have discussed about the candlestick charts and the anatomy of candlestick in detail. We have two colored candles, red and green. Green one is bullish, red one is bearish. So the candle is green when its closing price is greater than the opening price. And for the red candle, the closing price is less than the opening price. So these candlestick charts help us identify the gaps, and traders understand these gaps and their statistics and use their skills to make profit. Next, we talked about gap up, gap down, and their subcategories: partial gap up, full gap up, partial gap down, and full gap down. So this was the identification of gaps, and we had a clear idea on it. Now in this video, we will proceed and learn the new concepts and look more deeper into the gaps. And the same rules can be applied on any of the trading instruments like stocks or indexes. Let us begin with the various scenarios of gap trading. Let's see the first one. So here is the candlestick chart of HDFC Bank. We have chosen different days depending upon the gap formation and suitable for scenarios that we shall be discussing now. So this is of 21st and the day's high is at 1493, low at 1472, and the day's closing was at 1487. Now the opening on the next day, that is the present day, let us consider it as the present day, is at 1482. So as the day's opening is in between high and low of the previous day, so it is a partial one, it is partial gap down, and market has opened below previous day close and above previous day low. So it is a negative day and the day's candle should be red in color. So whenever we get partial gap up or gap down, in both these cases, previous day high becomes resistance and previous day low will become support. And so, do we all know what happens at support? At support, buying is done. One thing to remember is selling must be done only if the support is broken. The blue dot that you see is the opening of the next day or the present day, that is at 1482. And after opening, we need to notice if the price is moving up or down. And in this case, the price is moving down. We need to check if the stock or price is taking support at the support area or not. So how do we identify that? It will keep on forming green colored candles at the support area if it is trying to take support. But it doesn't happen in this case. It keeps on forming the red colored candles and also breaks the support area. So here on 22nd, we must short trade because the price is breaking the previous day low. And in case if we see green candles beginning to form at the support area, we would go for buying. So just remember that selling is done only when support area breaks down. Now let us see another example or scenario. This is of 22nd. Here the two levels, high and low, at 1498 and 1456 respectively, and the two dots stating opening and closing at 1481 and 1498 respectively. It is all about the previous day. Now let us talk about the gap. On 23rd, assuming it to be the present day, opening at 1505. And now we will be able to identify the type of gap. So this is the case of a full gap up. We need to follow a simple rule here that is called as the opening range breakout, or ORB, where we observe the first 15-minute candle of the present day and then take the decision. We will keep 50% of the 15-minute candle size as the stop loss, and the target will be the height of the candle. So according to the rule, we must buy trade. And here in this situation, we notice that after gap up, it is struggling to go up, and the market does not continue the bullish sentiment. This is an important trade where most of the traders lose their capital. So it was reversal. Initially we thought that the market was bullish, so we should buy. But in such situations, we must take entry near the support, which is the high of the previous day. So in this example, we notice that the price is not bullish, so it is best we do not do gap trading, and we will see another example to understand it better on when to trade. Now let us see the next one, that is full gap down, considering the date to be 28th, and previous day high was at 1438, previous day low at 1413, and previous day closing price at 1428. So on the next day, that is on 1st, the market has opened below the previous day low. So this is the case of a full gap down. The market here is bearish. Whenever we see full gap down in market, and in such scenarios, the low of previous day becomes resistance, and that is a strong resistance, that is at 1413. And in this case, we go for sell trade. So in full gap down or full gap up, we follow ORB technique, which is opening range breakout. So whenever the price is in full gap down state, we need to observe the first 15-minute candle. In this image, you see the same chart spread more to have a better view on x-axis, that is the time axis. Now assuming first to be the present day, observe the first 15 minutes. We are using ORB to short sell the market here. We will mark low of first 15 minutes of candle and we will go short below it. Stop loss will be 50% of the 15-minute candle and height of 15-minute candle will be our target. Let us understand why we are doing this. As the market was in full gap down state, it shows that the market was strongly bearish, and soon after the market opens, it still continues to break the first 15 minute, implying that the bearishness of the market is still continuing. And so this is why we take short trade below the low of the first 15-minute candle. I hope this is clear. Let us move to the next one. Now let's see the case of a full gap up. So the day's high was at 1408, low at 1372, and closing was at 1395. We observe the present day market here. It is opening above the high of the previous day. So as discussed before, when we have full gaps, either full gap up or full gap down, just follow ORB. So here observe the first 15-minute candle. So as it is a gap up case, so we need to buy above the high. Here also 50% of the candle height is the stop loss, that is marked in blue color, and we will keep candle height as the target. So we will have to trade with logic and calculated risk, and the reward should definitely be favorable. Target is usually double the stop loss. So that's all in full gap up scenario. Now let us see another case. Now let us see the case of a partial gap up. So the day's high was at 1517, low at 1473, and the previous day closed at 1499. Now the day's opening is at 1508. So this is partial gap up. It is a negative day. So whenever we get partial gap up or partial gap down, the previous day high will be our resistance and the previous day low will be our support. So on first, the market opened gap up and the market went up and came down and went up again. Now something to remember at this point is never buy when the market is moving up. That is, when the market is moving up soon after the gap. But we should buy when it comes down and begins to move up again. At this point, we take the entry. This is because the market follows a structure So never run behind a running price. Let it settle down, and when it begins to go up, at that point should be our entry. So just remember that we will be safe if we follow the rules, that is by using previous day high as the resistance. So when the market opens with partial gap up, it shows that the market is positive. So just look for a selling candle and buy above that selling candle and keep the stop loss at the immediate support. Buying should be done in orange circle that is marked for you. So after looking for selling candle, which is red in color, market begins to form green color candles where we enter, that is our point of entry, and we go long. From point of entry to stop loss multiplied by 2 should be your target. Here it is denoted by brown and maroon colors. So this is how you trade when you get partial gap up. I hope these methods and strategies will be helpful to all our viewers. You can join our Telegram channel Discuss Nifty for more such interesting discussions on trading. I hope you all have a great time and happy trading everyone.